You know what's crazy? It's like my greatest fear and my greatest expectations came true almost all at the same time. I told you I was highly concerned that long before interest rate cuts that the market would start anticipating it in a rally to God knows no end, and that's what happened today, baby. Our favorite dividend stocks, literally the world of dividends, is outperforming tech today because of the Federal damn Reserve. I mean, the Fed came out dovish, hey baby, things are cooling down, and everyone's like, let's just price it into the market now. That's why I dumped like 20 grand into the market since basically October. I took every dime I had. I bought dividend stocks, I bought the S&P, I bought SCHD, and we've been printing, baby. Like my parents just retired a couple months ago, and I'm so grateful they didn't get too instilled into the fear that everyone was pushing you to just put money in high interest savings and GICs, because that was not the correct thing to do. The correct thing was to lock in these crazy high yields. And let's talk about it. Let's take a look into some of these ETFs and some of these stocks, because it's quite astounding when you actually take into consideration that the dividend realm, things that are highly affected by interest rates, just absolutely crushed the market today. On VO or on S, basically we just take a look at stock twits. On VOO here, we're up 1.35%. On SCHD, 1.65%. Right after that wonderful dividend being reinvested, so that helped out. You got QQQ at 1.22%, and this isn't even the fun part, right? Like these are just the U.S. stocks, with SCHD absolutely crushing the rest. But you take a look at the REIT indexes out there, the REIT ETFs, like the VNQ here, which is up 3.83% today alone. Over the year to date, this thing is recovering from the October low, up a whopping 22%. My God, let's take a look on the Canadian side of the border, because this heavily affects Canadians as well, with VDY outperforming all of them. Crazy. 1.8. When? Oh, the Canadian stocks are garbage. Yeah, you should only buy U.S. tech companies. I'm just saying, folks. Like, it's funny how God, it's just the discounted value that we're so written off were dividend stocks. That's it, because a lot of them are infrastructure and debt. Like, it's like the most simple thesis to understand ever, yet people just don't believe it. They're like, oh, past performance equals future return. And then they're like, oh, well, because this went down a lot, it's going to keep going down, duh. And then look at what it did. It jumped up 10%, baby. If you were buying some of these lows here, you laughing. You loving it. I'm not trying to be too high strung, but I feel like I've been fighting an uphill battle with a lot of people. The Canadian banks crushing it, double-digit points today. I mean, look at this, 1.8%. We're almost getting into the 2% range. CM is up 2.5%. Shouldn't really be saying it's double digits. We're getting excited over a couple of percentage points here, but it's just wild to see what happens. Like, even the speculative market is doing exceptionally well on this dovish, Fed. But the thing is tech stocks have gotten overbought, right? So I think it's small caps we're going to see rallying here. Look at PayPal up 4.8%. Just anything that has been written off is just trash. TELUS is up, almost 1.5 points. Look at RioCan here. RioCan, the Rio clan. My wife has been holding these shares strong, but a 6% gain in a single day. Look at BCE up 2%. Enbridge, even against this horrible oil market, like anything that has been devastated by the interest rate cycle is coming back. And that is what we're likely to continue to see. So what do you want to do here? Well, you don't want to be holding GICs. You don't want to be holding anything that is basically stiff cash, because who cares about 6%? The returns we're making this year in the market are nuts. Like, even if you've been holding VDY since the beginning of the year, you're only up 1.38%, but you've been getting damn near a 4.5 to 5% yield on top of that. So you're up more than your GIC's already going to be up. If you've been holding VOO, for example, look at this year to date, you missed out on a 23 plus the dividend, probably about a 25% gain over chasing a 6% safety investment. Anyways, I'm just kind of beating up everyone that's investing in GICs, because I'm telling you, you don't want to invest in GICs until, or bonds or money market funds, literally until the first interest rate cut. Because the market is going to rally into this anticipation, and we could probably see all-time highs, as mentioned, before the end of the year. I would not be surprised if this actually happens on these anticipations. We're 0.94% away from an all-time high right now. If you're on the Canadian markets, you're already an all-time high because of the dollar conversion. We mentioned this yesterday. But what you want to do is just ride this rally. Just take it all the way until March, summer, when they start saying, hey guys, I think it's time to cut interest rates. Then you're going to take some of these profits, some of these gains, and guess what you're going to do? Because a lot of it's going to pre-price into the market. You're going to take that and you're going to dump it into GICs and bonds. And you're going to lock in rates for 5 years, because you're never going to see a 6% GIC here in Canada again probably for the foreseeable future. I mean, let's be real. When this next interest rate cut cycle comes into play, which, the Fed just basically said, hey, we're pretty much done with the interest rates, right? So basically, we're never going to see this again. I don't think for the next 10 years we're ever going to see, well, I just want to see the chart. See the interest rate chart here. Why can't I find this? Trading economics. Yeah, here we go. So in the U.S., right, we're peaked. This is going to be the end of something we haven't seen in like literally 10 years, and we're probably not going to see it for another 10 years. They're going to pull back, and by probably this time, long before this time in 2025, probably by the first quarter, second quarter of 2025, we'll probably get back to a nominal 2 to 3% interest rate if I had to guess. But again, you got to remember that no one's going to want to make 3%. Nobody's going to want that from interest rates anymore. They're going to want the 5, 10 plus percent you're going to be making off market average returns. And now that there's FOMO in the market, we're going to see some chasing going on, right? And eventually we'll get some profit taking. But I'm telling you, just ride these wonderful cheap dividend stocks that are still trading at favorable values. Get into that first interest rate cut cycle, take some of the profits, take some of the income that you're making, and dump it and lock up some like 5, 10 year, even if you can at 6%. And just, you'll be in the best place imaginable then. And I think it's the only thing you can really do at this point. And again, I'm giddy as hell and I'm loving this market environment. I know a lot of people probably going to be upset by this because they're missing out on the gains, but I told you so. Freaking told you so. I hate to say it. I told you so. But hey, money printing, baby. I mean, I'm buying boring shit. I'm not even buying tech stocks that we're printing today. I love it. I love it. Anyways, folks, stay cool, stay awesome. Catch you in the next one.